Even in the face of reduced profitability, most commercial banks last year performed fairly compared to many other sectors of the economy, going by the recently released results by the players. Some actually posted profits northward of 90 billion shillings.
You know, banks have what we would call a safe haven. When things are not working out, the only direction they run to is to the central bank to buy bills and bonds, which are near zero risk. So any conservative banker will look at that as the only avenue to, invest. Now, you can even see that now it is reflecting through the lower yields. This is the lowest we've ever come in terms of bills and bonds, 8-9%, never seen. The reason is every banker is scrambling to go in the fixed income space.
Also true is that as banks focused on that risk-free direction, the private sector found itself crowded out. All this came at the back of suppressed economic growth, marked by the winding down of some major players like NAGMAT, low demand, a fair number of non-performing loans, the continued protracted request of a bailout by several distressed businesses, and the persistent failure by government to meet its state obligations to local suppliers. While today the cost of money has significantly come down to as low as 17% interest on loans, a bigger part of 2017, the prior period, was a fairly different story, a position that the Central Bank and the Ministry of Finance also seem to agree with.
Lack of access to secure and affordable financial services such as credit and savings reduces household ability to invest, save and respond to shocks.
So from the foregoing, we must identify the various factors impeding access and use of financial services. And I will not miss this chance again to bring out the issue of the interest rate spreads. 10% is still very high as an interest rate spread.
The situation, according to the Central Bank, is mainly because of the failure by some players to manage the cost of doing business, which result into many of these extending the cost to the borrowers.
A bank operating in Uganda where non-interest expenses as a ratio of gross income averages 59. It averages 59 in Uganda compared to Kenya, which is about 52. So Uganda is a very high cost economy in terms of delivering financial services. I should actually mention there are banks with a cost to income ratio of 90%.
But circumstances are changing, according to some observers. Banks have picked the Central Bank signal of lowering its benchmark rate to an all-time low of 9%, with some charging as low as 17% interest on loans. However, the cumulative impact of the industry's prior misgivings and those beyond the financial sector have crushed the loan appetite.
Banks are sitting on quite high levels of liquidity, but there is no uptake from the private sector. Now, you ask yourself why. The answer to that question is that there is no vibrant economic activity in the economy to enable the private sector to pick up credit. Now, because of that, PSC is constrained, but also businesses are almost at a standstill because they cannot expand, they cannot produce, and they remain where they are.
So the business community believes that the cost of money in an already distressed economic environment in the year 2017 worsened their woes, leading many into losing their property to the banking industry, and is also the reason why many are keeping away from picking credit. True, however, is that banks are still making money through other avenues. Whether that is sustainable or not is another subject. Malcolm Sime, NTV, Money and